Hello again. This is Andrew Westhof, Senior Loan Officer and owner of Homes Mortgage Lending. And today I want to talk to you about some credit mistakes to avoid while you're purchasing a home. So, first thing is you don't want to open any new credit accounts while you're purchasing a home. Two reasons. One, that new account is going to hurt your credit score because it's new. The credit bureaus do not have any credit history on the account, no payment history. So they don't know how you're going to be able to handle that new debt, if you're going to be able to make that payment fine every single month or if you're going to struggle. So for that reason, that's new account is going to ding your credit score. And we want your credit score as high as possible to get you the best interest rate and qualify for the best loan terms. Also, the payment on that new loan or that new credit account is going to be figured into your debt to income ratio. So it's dollar for dollar on what your home payment is going to be, meaning if you have a new car payment and it's $300 a month, that's $300 less that we can qualify you for on the home purchase. Your debt is dollar for dollar difference on what we can qualify you for. So if you have $1,000 in monthly debt, if you pay it off, you can qualify for $1,000 more on a home payment. That's how debt to income ratios work. So if you're struggling to qualify or you want to qualify for more, paying off debt is going to be the key, not taking on new debt. Don't make any large purchases on credit because if we've already pulled your credit, the credit's good and we qualify, this probably isn't going to come up even if you do it, but there's a risk that it will because we might need to repull your credit, so you just want to avoid it. There's no it's not a good time to charge up the credit cards. So if we have to repull the credit and the balances on the credit have gone up and the monthly payments have gone up, we have to include those new payments in your debt to income ratio, so you'll qualify for less. If you already have a loan in process and now you don't qualify with the new payments, then your loan's not going to go through, or you got to pay the cards back down or off. But even if you qualify with the new payments, the higher balances on your credit card are going to affect your utilization and will ding your score. Sometimes a lot. It's the second biggest thing that affects your credit aside from payment history. So utilization of your revolving debt is 30% of your credit score. And then really just don't have your credit pulled by anyone aside from the mortgage company. This is about the worst time to shop for a car, get a new credit card, have your credit pulled for really any reason. So just avoid that. Don't think, hey, it's probably not a big deal. If you do feel like you need to buy something on credit or have your credit pulled for some reason, talk to your loan officer about it, because there are some situations where it's not a big deal. For instance, I've had clients whose auto leases are coming up and they want to purchase the automobile or get a new lease or whatever the case might be. So talking through that with your loan officer is definitely going to be the right situation, because maybe it's not a big deal, but if you can avoid it, just avoid it. You can, as soon as the loan closes, you can do whatever you want with your credit, and it's not going to affect the loan. So don't make a what you think might not be a big deal mistake right before you purchase the house. So a few bonus tips. First, before you have your credit pulled for your pre-approval, pay your credit cards down to 10% or less of the credit balance and leave them at that 10% level or lower up until your credit is pulled. You really want to do this about 45 days before you're going to get pre-approved. So the way that credit cards report to the credit bureaus is once a month they send the information over to the bureaus. So for instance, say you have $1,000 credit card limit. Once a month, the credit bureaus just send whatever the balance is that day to the credit bureaus and what that minimum payment would be if that was, the balance when your payment was due. So if you pay your credit card off every single month, but the day that they sent in the balance to the credit bureaus, it was at $800 because you had a large expense, put it on credit, you got your points, your rewards, whatever the case is, but then you're paying it off each month, so you're not really worried about it. Well, that $800 limit is 80% utilization, which is pretty high. That's going to definitely ding your score a decent amount. It'll depend on how many other credit cards you have, what those balances are, what your payment history is. So there's a lot of factors. But even if you have excellent credit, aside from your utilization, having a high credit balance on credit cards will definitely bring your score down. So rule of thumb, 10% or lower. if you're able to, and keep it there for 45 days before you get pre-approved. Um, so the reason I tell you about the snapshot thing is because I've had clients before that, they pay their cards off every single month, but they do get pretty high compared to the limit on their balances, and they're wondering why when I pull their score it's 700 instead of 760 because they have perfect credit history. The other thing you can do if this is really difficult for you to do because you are using those credit cards as your regular way of spending and then paying them off each month, you can contact the credit card companies. You can call them and ask when they report to the bureaus. So if you know that date, you just pay them off a few days before the date that they're going to send to the bureaus, and that works as well. A little bonus tip here. So I know I mentioned on the previous slide, don't have anyone pull your credit. The mortgage company is the caveat to that. Now, yeah, our inquiry is a hard inquiry, just like a credit card, a car loan, anything else. However, you have to have your credit pulled to get pre-approved and get a mortgage in process, so it kind of is what it is. But you can have as many mortgage companies pull your credit within a 30-day period as you want, and it only hits you for that first inquiry, whoever pulled your credit first. Auto loans, credit card companies are not like this. So don't think you can shop around for your auto loan and you're not going to have your credit ding. If you have 30 companies pull your credit for an auto loan, it can hurt your score quite a bit. But if you have 30 companies pull your credit for a mortgage, as long as it's within 30 days of the first company that pulled it, it doesn't hit the score at all. So the reason I tell you this is because it's good to shop around. A home purchase is probably the biggest purchase you've ever made, and you're going to get a loan out for it. So talk to several lenders at the pre-approval stage. Have them all pull your credit. That way, when it's time to actually get a loan in process, when your offer is accepted, you can talk to all the lenders that already pulled your credit. You already have you pre-approved, and quickly give you a quote, so you can quickly make a decision on who has the best terms and rates that you trust and move forward with them. And then this is a little bonus. I'm going to make a video on this, so keep an eye out for that. But after July 1st, the way that medical collections report to your credit are changing. Now, it used to be that with any collection, once you pay it off, it still shows as a paid account. So any derogatory marks on there are still going to hurt your credit. With medical collections, if you pay off medical collections after July 1st, it just comes off of your credit report altogether. And then also, if you have medical collections $500 or less, they're not even going to show up. So kind of a good switch. Again, I'm going to make a video on this to give you some more detail. But if you're someone that has some medical collection and you're kind of thinking about how to have the best score possible when you're going to get pre-approved, if you pay that medical collection off now and you're getting pre-approved sometime after July 1st, 2022, then you're not going to have that on there. So that would be a good thing to target, because it could help your score. Certainly talk to a loan officer about your situation if you're not sure how it's going to impact things. So I hope this was helpful. If you do have any questions, I'll put my contact information in the notes. If you're in the state of Michigan and you'd like to work with a knowledgeable lender, please don't hesitate to reach out to me. But please feel free to ask any questions in the comments, and I will be try my best to answer them as quickly as possible. Thank you.